So now we're going to take a look at some practice problems from Chapter 9 for stock valuation. So here's how we're going to approach it. Now, remember that stock represents ownership, and ownership can last forever. And so therefore, when you're thinking about how to value a stock and you use the discounted cash flow approach, then you have to account for the fact that cash flows can potentially occur forever. And that brings us to the perpetuity formula, which we saw in the chapter on the time value of money. So the perpetuity formula is relatively simple. It says that price today is equal to the cash flow that occurs every year divided by the required return for the year. That's relatively simple, right? We've seen that before. All we're doing now is applying that concept to stock valuation, stocks in particular. Okay, that's where we're going to start, and that's the simplest case, but we need to make it a little bit more realistic. And so there's actually an adjustment we can make that is still relatively simple, but it allows us to assume that the cash flows will grow at a constant rate over time. And that brings us to the constant dividend growth model. What that says is the price today is equal to the dividend in the next year, so the next dividend paid, divided by the required return minus the dividend growth rate. So you can see it's still relatively simple, and it allows us to account for a dividend that is growing over time. So what makes this different from the zero dividend growth model is that now we're assuming the dividend is changing. So if you look year to year, the dividend will be different. Whereas in the zero dividend growth model, the dividend was the same across the timeline no matter where you look. But even with the dividend growing, knowing the growth rate allows us to be able to calculate what the dividend will be in any period we want to. But for this formula, what's important to understand and remember is that we need to include D1, which is the next dividend paid, the dividend paid at the beginning of next year or at the end of this year, however you want to look at it. Okay, so that's probably the most important formula. There's also the dividend yield, which we define to be the next dividend paid divided by the price today. And then there's a formula here allowing you to figure out how to calculate the next dividend. So if you're given the dividend that was just most recently paid, which would be labeled as D0, and you need D1 for the constant dividend growth model, then it's a relatively simple adjustment. G represents the dividend growth rate, and all you have to do is take D0 and multiply it by 1 plus G, right? Because all you're doing is growing the dividend by 1 year at the dividend growth rate. Okay, then there's a whole nother method of valuation that we call relative valuation that is not based on discounted cash flow at all. In fact, the valuation is based on a benchmark relative to peers. And for that, you need a financial ratio that includes the valuation. You need some valuation ratio. So what we're going to focus on, probably what is most common, is to look at the price to earnings ratio. And so the way you do this is you say, okay, the price today, my price estimate is going to be based on the earnings of my company today multiplied by some benchmark price to earnings ratio. So if you think about it, what this says is that price is equal to the company's earnings per share multiplied by some benchmark price to earnings ratio. Right? And so this right here represents the benchmark. And when you multiply these together, the EPS by the benchmark, you can see the EPS cancels out. And you're left with a price. Okay, so we'll look at that in just a minute. Let's start with the simplest case, which is the zero dividend growth model. In this case, we have Shiny Shoes Company. They plan to pay a constant dividend of $5 per share forever and ever. If the required return is 10%, what is the current price per share? All right, so remember, this is the simplest case. The dividend never changes, And for that reason, we can use the perpetuity formula that we're already familiar with. And what that says is the price today is equal to the dividend divided by the required return. And what this looks like is, well, the dividend we're given is $5 and the required return is 10%. So 0.1 is what we put down there at the bottom. And you can see that gives us a price today of $50. Pretty easy, right? The next one is the constant dividend growth. Now we're assuming that the dividend is changing over time, so it's a little bit more realistic. We're assuming that the dividend will change over time, but it's growing at a constant rate. Okay, so in this example, we have Jamestown Shipping Company just paid $1.85 to its shareholders as the annual dividend. Simultaneously, the company announced that future dividends will be increasing by 4.1% per year. If you require a rate of return of 8.3%, how much are you willing to pay today to purchase one share of the company's stock? All right, so let's remember the formula, which tells us that the price today is equal to the dividend next year, or the next dividend paid, D1, divided by the required return minus the dividend growth rate. So all we have to do is identify what it is that we've been given and plug it into the formula and do the calculation. So we're given the dividend of $1.85. Now, which dividend is this? Well, notice that the language says just paid. That means D0 is going to be equal to $1.85. We need D1. We need the next dividend. So how do we calculate that? Well, it's easy. All we have to do is take this D0 and grow it by 1 year at the dividend growth rate, which is 4.1%. And that gives us $1.93 approximately. Okay, so that is our D1, and that's what we're going to put into the formula. So let's do that. We'll say 1.93 divided by the required return, which is 8.3%, so 0.083, minus the dividend growth rate, which is 0.041. All right, so 0.083 minus 0.041 equals 0.042. So then we just take 1.93 divided by 0.042, and that gives us 45.95. And that's our answer. Okay, let's look at another example to really solidify this idea. Braveheart Burgers is expected to pay a dividend of $2.95 next year. The company's dividend growth rate is expected to be 4.4%, and investors require a return of 10.6% on the company's stock. What is the stock price today? All right, so again, we're using the formula that assumes constant dividend growth, which says the price at time 0 is equal to D1 divided by R minus G. Now, in this example, we're given D1 because notice the language. They're expected to pay a dividend of $2.95 next year. That tells us that D1 is equal to $2.95. So $2.95 divided by R minus G, which is 0.106 minus 0.044. 0.106 minus 0.044 is 0.062, so we have $2.95 divided by 0.062, and that gives us $47.58. And that's our answer. So far you can see that it's really not so bad. The most important thing that you need to remember is that, it's all based on this formula. We're not using the time value of money function in the calculator. We're using the formula here. And that is because there's no finite maturity, right? The cash flows can go on forever and ever. And so for that reason, we need some perpetuity type formula. All right, so in this case, in this particular formula, you can see what we need at the numerator at the top is D1. That's one of the biggest areas where students get tripped up is, they don't recognize, they see the problem states that the company pays a dividend, they just throw it in there. Typically, I'll give you either D0 or D1, and I'll leave it up to you to figure out which it is that I'm giving you. If it says that the dividend was just paid, that indicates you're given D0. If I say the dividend, the next dividend to be paid, that indicates D1. Okay. All right, so let's, shake it up a little bit, and this time we're going to calculate the dividend. In this case, the stock currently sells for $87. The dividend yield is 3.2%, and the dividend growth rate is 4.5%. What is the amount of the dividend to be paid in 1 year? Well, notice that we're given a dividend growth rate. So because of that, you can probably assume we're going to be using the constant dividend growth model. So let me go ahead and write that down. P0 is equal to D1 over R minus G. Now, notice that in this problem, we're given P0 because we're given that the stock currently sells for $87. We're given the required return. Let's say the dividend yield actually is 3.2%. We're not given the required return quite yet, and we're given the dividend growth rate is 4.5%. All right, so the dividend yield is defined as D1 over P0 equals the dividend yield. We'll write that as dy. So in this case, it's relatively easy to calculate this because we're given the dividend yield, which is 0.032, and we're given P0, which is $87. So one strategy is to say, okay, what's 87 times 0.032? D1 is 278, and that's our answer. All right, next we have constant dividend growth. This problem says Simon Supper's company has announced that it will pay a dividend of $4.15 per share 1 year from today. Additionally, the company expects to increase its dividend by 4% annually. The required return on the company's stock is 10.2%. What is the current share price? All right, so again, we're using the constant dividend formula. So we're going to say P0 equals D1 over R minus G. Now, we are being asked to calculate the current share price, which is P0. So P0 is what we need to calculate. Required return we're given. The next dividend paid we're given. And we're given the dividend growth rate. So it should be relatively easy. D1, because it says 1 year from today, D1 is going to be $4.15. Going to be divided by the required return, which is 0.102, minus the increase in the dividend, 0.04. So 0.102 minus 0.04 is 0.062. So 415 divided by 0.062. That is $66.94 approximately. So that one was relatively simple. Okay, so here's where it gets more complicated, right? And because the real world is definitely more complicated than what we've been looking at here, we need to sort of have an understanding of how we might tackle those problems. Okay, so let's look at this one. New Gadgets currently pays no dividend, but is expected to pay its first annual dividend of $5 per share exactly 9 years from today. After that, the dividends are expected to grow at 3.7% forever. If the required return is 11.5%, what is the price of the stock today? All right, so for a problem like this, it's going to have multiple parts. And so we need to understand what each part looks like. Now, in the problem, it's relatively simple if you are standing at time 8. And to give you an idea of why, let's draw the timeline. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay, now in the problem, it tells us that the first annual dividend will be paid exactly 9 years from today, which says right here. So at this point, we will start paying $5 per share. And going forward in the future, it will increase by 3.7% forever. So you can imagine, if we are standing at time 8, looking forward, then we can easily apply the constant dividend growth model. So let me do that. Let me say P8, the price at time 8, is equal to D9, always the next period dividend, divided by R minus G. So D9 is $5. R minus G is 0.115 minus 0.037. That's given to us in the problem. That is $5 divided by 0.078. That gives us 64 and 10 cents approximately. Now $64.10 represents the price at time 8. So how do we take that and figure out what the price is at time 0? Well, we go back to our basic time value of money. We take this $64.10 and we divide it by the discount rate, or 1 plus the discount rate, to the power of the number of years that we're discounting. In this case, we're standing at time 8, so we need to go back 1, 2, 3, 4, 5, 6, 7, 8. All right, so we have 1.115 to the power of 8. So it's going to be 6410 divided by 2.3889 or so. And that gives us $26.83. And this right here is our P0. That's the answer. So let's quickly recap what I just did. So in this non-constant dividend growth example, you can see that it has multiple parts. In the first part, like as a whole, it seems complicated. But if we break it into 2 parts, we can see that both parts are relatively simple. The first part, we stood at time 8 looking forward, and we used the constant dividend growth model, which makes it relatively easy. And we calculated the time, or the price at time 8. And then we said, okay, we need to calculate P0, not P8. So we take this time 8 valuation, and given the required return, we discounted 8 years to time 0. And that gave us $26.83. And that is P0. Okay, so here's another one. This is more complicated as well. It's changing dividend growth. And this is about as realistic as we're going to get. So the example says the Bellwether Company is a new firm in a rapidly growing industry. The company is planning on increasing its annual dividend by 18% a year for the next 4 years, and then decreasing the growth rate to 6% per year. The company just paid its annual dividend in the amount of $3.20 per share. What is the current value of one share of this stock if the required rate of return is 8.7%? Okay, so what in the world is going on in this problem? Well, for problems like this, it definitely helps to draw a timeline. Just visualize what's happening with the cash flows. Because ultimately with this discounted cash flow valuation, all we're doing is calculating the present value of the cash flows on the timeline. So that's what we need to do. Now, we are given that the company just paid an annual dividend in the amount of $3.20 per share. So $3.20 was the time zero dividend, so D0. We can see that it's planning on increasing this annual dividend by 18% per share for the next 4 years, and then decreasing the growth rate to 6% per year. All right, so 1, 2, 3, 4. I start with $3.20. I multiply by 1 plus 1, 8 to grow it by 18%, and that is 3.776 times 1.18, 4.46 approximately, times 1.18, that's 5.26, times 1.18, 6.20, so $6.20. So it's kind of cramped, but you can see we've taken 1, 2, 3, 4 years. 4 years of 18% dividend growth. That's what we just calculated. Now, after that, the growth rate decreases to 6% per year forever. So we have 1, 2, 3, and as far as we want to go. Now 6.2 times 1.06 at the new dividend growth rate, that next dividend is 6.57. And we can calculate, using the 6% growth rate, any dividend that we want to. But we don't necessarily need to. Notice that if we're standing right here, looking forward, and this is time, let's see, 1, 2, 3, 4, 5. If we're standing at time 4 looking forward, then the dividend growth rate will always be 6%. Now recognize that that is an indicator that we can use the constant dividend growth model at time 4. In other words, you can say, well, the price at time 4 is equal to D5 over R minus G. D5 we calculated to be 657, and R is, 8.7, and the dividend growth rate is 6%. So we can calculate what the price will be at time 4. $2.43 and 33 cents. Now this doesn't help us quite yet, or we're not finished yet. This is just what the price will be at time 4. But notice that if we go from time 0 to time 4, we collect all of these dividends in the meantime. So ultimately the price today is the present value of these dividends plus the present value of this amount right here. So if I want to write it out, then it looks like this. 3.78 approximately divided by the discount rate or the required return, which is 8.7% to the power of 1 for 1 year, plus 4.46 divided by 1.087 to the power of 2, plus 5.26 divided by 1.087 to the power of 3, plus 6.2 divided by 1.087 to the power of 4. And then the last thing is this sum right here, which is 243.33 divided by 1.087 to the power of 4. So it's kind of long and drawn out, and I can let you do the math here. But the basic idea is that we have these dividends at time 1, 2, 3, and 4 that have this abnormal growth rate of 18% per year. But standing at time 4, looking forward, the dividend growth rate is always the same at 6%. And so therefore, at time 4, we can use the constant dividend growth model where we said P4 is equal to D5 over R minus G. And we can take that sum and discount it 4 years, right? We're standing here, 1, 2, 3, 4, brings us back to time 0. And this entire sum is the price that is represented today, the price at time 0. All right, so this problem you can see is pretty long, pretty drawn out, has multiple parts, but this is about, obviously the real world is more complicated, and this is about as complicated as we're gonna get. All right, so let's talk about something completely different. So this is relative valuation as opposed to discounted cash flow valuation, and the approach is slightly different. What we're not gonna do is estimate the cash flows and compute their present values. We're not going to do that. Instead, we're going to look and see at how similar companies are being valued according to their fundamentals. Fundamentals, an example being earnings. We're going to look at how these peer companies are valued, and we're going to value our target company in the same way. Now, in order to do this, you need some valuation ratio, right? Some ratio that tells you what you're paying or what the value is relative to what you receive or what you get in return, which is, in this case, earnings. So the value relative to some aspect of fundamentals. Now, as we've seen before, there are many valuation ratios out there. And so price to earnings is just one. It's probably the most popular, but it's just one. And so, you can see, you can take any valuation ratio and apply this logic. And for the price to earnings ratio, you can see, what do we need? Earnings. And if earnings is 0 or negative, then it's going to really mess with our ratio and we're not going to be able to get the right interpretation. So for young startup companies that are not quite cash flow positive yet in their operations, a lot of times they'll use price to sales or some ratio like that and compare companies that way. All right, so to see this in action, let's look at this example. Sand Key Company has earnings per share, EPS, of $4.30. The benchmark price to earnings ratio is 19.5 times. What stock price would you consider appropriate? All right, well, basically the idea here is to say the price is equal to our company's earnings per share multiplied by some benchmark price to earnings ratio. So you can see it's pretty simple, pretty straightforward. Our company has earnings per share of $4.30, and we know the benchmark is 19.5. So we just take our earnings and multiply it by 19.5, And that gives us 4.3 times 19.5, $83.85. What does this mean? It says that if we were to value this company relative to similar companies, then the value should be around $83.85. So then we can look at the actual valuation and say, if the stock price is $70, we can say, okay, this company is, a little bit undervalued relative to its peers. Why is that? Does the market see something in that company that makes it different, that is, not so good? Or is the market mispricing the company, and its stock price is too low? Right? That's something for you to decide, and it's definitely not easy to figure out which one is the case, especially given the fact that the stock market is pretty efficient. Okay, another thing to think about is where this benchmark PE ratio comes from. And that is more of an art than it is a science, because you can choose maybe a few companies, like 1 or 2 or 3 or 4, or you could use like the entire industry. But you can see the more companies you use, the less appropriate it's going to be. The fewer companies you use, the more idiosyncratic your benchmark is going to be. And so because of that, there's not a perfect way of doing it. And some companies, like Tesla, for example, doesn't really have a good peer firm or a good set of peer firms. You may look at other auto companies, but Tesla's a little bit different. It's more tech-oriented. So you may look at tech companies, but tech companies aren't exactly in the same industry as Tesla. So it makes, for companies that are very unique, like Tesla, it makes it very difficult to apply this relative valuation. At the same time, for a company like Tesla, where the cash flows are so uncertain and the future cash flows are very hard to predict, well, it makes discounted cash flow valuation a little bit less informative as well. So, some companies are just really hard to value, and what you'll find is that in practice, you typically see a lot of price or return volatility for those companies, right? A lot of disagreement in the market about what the valuation should be. And that can drive, that disagreement can drive volatility in the market. Okay, so just a few last remarks. What gives a stock value? Well, in the way we've been approaching it, a stock has value because it generates cash flows in the future. If you hold a single stock forever, if you never sell it, where does your return come from? It comes from dividends. So that's why, we've approached this in a way that, we assume that we're going to be holding the stock forever. And so therefore the return comes in the form of cash flows accruing to us, which are dividends. So what gives the stock value? Future cash flows. In the formula, this right here, the constant dividend growth formula, what period is the dividend for? That is, very important to remember when you're solving these problems. It's always the next period dividend from the price. So this is going to be 4, D4. And then lastly, what does an increase in the interest rate mean for stock prices? And this is something just to kind of get you thinking, especially about, we've always assumed this required return as given. But in reality, that's something that we'll need to estimate. And that, that discount rate or that required return is sometimes not easy. But what does an increase in the interest rate mean for stock prices? Well, if you think of R as being like a risk premium that we've seen before, you have the risk-free rate plus some risk premium. Well, if interest rates rise, it's assuming that the risk-free rate rises, which will cause an increase in the required return, which will decrease the price. Okay. If you guys have any trouble with this, please send me an email. I am always happy to help.